Hello, everyone. I'm Sean Garcia, Marketing Manager here at Mazars in the U.S., and I'd like to thank you for attending our webinar. Today, we begin our REIT webinar series, and we'll be presenting Why a REIT, which will be led by Craig Stern, Donald Zeef, and Bonnie Zukoff. Before we begin, I'd like to review a few housekeeping items. First, we encourage you to ask questions. To do so, please send them to us using the Q&A box on the lower left-hand side of your screen. We will try to answer all of your questions during the webinar, but if a fuller answer is needed or if we run out of time, your question will be answered after the webinar via email. Second, to earn the available 1 CPE credit during today's webinar, you must listen to at least 50 minutes of the presentation and answer at least 3 polling questions. The polling questions are a series of questions meant to confirm that you are actively attending this webinar. Please note that you must be logged in individually to receive credit for today's webinar. If you are attending as a group, only the individual who is logged in will receive credit. If you've completed the requirements, your certificate will be available for download at the end of the webinar. Instructions on how to download your certificate will be displayed on the screen at the end of the presentation, so please stay on the line. Lastly, you can download a copy of today's presentation from the green Resources button at the bottom of your screen. Here, you will also find our webinar Frequently Asked Questions, a document which offers some basic troubleshooting information and other useful tips. Again, this can be found under the green Resources button at the bottom of the screen. Now, thank you once again for joining. I'll hand it over to Howard Landsberg, a partner here at Mazars.
Thank you, Sean. Good day to you all. I'm Howard Landsberg, and I lead the real estate tax practice at Mazars in the United States. I'd like to welcome you to the first installment of the Mazars REIT webinar series, Why a REIT? Mazars is a leading international audit, tax, and advisory firm. We operate as a united partnership, as one integrated team who leverages our expertise, scale, and cultural understanding to deliver exceptional and tailored services around the globe. Mazars has more than 24,000 professionals operating in over 90 countries and territories. Throughout the webinar series, you will learn more about the Mazars REIT practice, our experts, and technical REIT subjects. The sessions move from a general REIT practical guidelines to more advanced topics. Today's webinar, Why a REIT, will be led by Craig Stern, Don Zeef, and Bonnie Zukoff. Craig has more than 30 years of experience in the real estate and investment industries with a focus on transaction services. He has worked on over 100 mergers, acquisitions, dispositions, joint ventures, inbound investments, and spin-offs with deal sizes ranging from $1 million to $6 billion. Don also has more than 30 years of experience in the real estate industry focusing on REITs. He is the co-author of the Real Estate Investment Trust Handbook published by Thomson Reuters. And lastly, Bonnie has more than 10 years of experience in the real estate industry and has spent a good portion of that time focusing on REITs. Thank you for attending our first REIT webinar series here, and here's Craig to start us off. Thank you very much.
Thank you, Howard. Good afternoon. My name is Craig Stern, and I am a Managing Director in Mazars Real Estate Tax Practice. So today we're going to talk about why REITs. Why a REIT? Today's agenda will include why a REIT, REIT formation, REIT operational rules, REIT level taxation, prohibited transactions, safe harbors and fact circumstances, taxable REIT subsidiaries, what is it and why we use it, and time permitting REIT-related elections. So let's start out with why a REIT. That question really is 5 questions packed into one. The first question is, why do REITs exist? The second question is, why should you or your client operate through a REIT? The third question is, why should you or your client invest in a REIT? The fourth question is, why are there so many REIT roles? And the fifth question is, why is there a specific REIT role covering a topic? So the objective of these seminars and webinars will be to discuss these questions and their related answers. The first question, why do REITs exist? To answer that question, we ask another question. What is a REIT? A little history will be helpful, I think, in this matter. Post-World War II, real estate was booming due to pent-up demand and the GI Bill, amongst other reasons. President Eisenhower and Congress wanted a vehicle to allow the small investor to participate in the booming real estate industry. The answer they hit upon was a hybrid entity, part C corporation, part partnership, and they called this entity a real estate investment trust, or as we know it, a REIT. So what are the advantages of a REIT? A REIT is an entity created by Congress as the real estate companion to mutual funds. Similar to mutual funds, it pays no entity-level tax if it distributes out 100% of its taxable income. Certain exceptions apply. REITs have similar advantages to mutual funds, such as a pooling of funds to allow the small investor to participate in larger and more important investment projects. It creates a diversification of assets. It provides for expert management of those assets, and it provides for marketability of shares. But conceptually, the REITs were designed to be passive owners of real estate. But as we will see in these seminars, over the 60 years since 1960, these rules have been liberalized and modernized so that they will represent today's REIT. So what are the tax advantages of REITs compared to C corporations and partnerships? Why are they of interest to real estate owners and real estate investors? So the first item is that they have simplified 1099 reporting versus K-1s. So there's no state reporting except for the owner's state of residence. So as I'm sure many of us know, getting the K-1 from a real estate partnership with 20, 30 states and having to provide tax returns in all those states, if required, based on gross income, is a difficult burden. REITs simplify that by only giving you a 1099. The second benefit is that there's generally no double taxation, unlike a C corporation, and no phantom income, except for consent dividends and taxable stock dividends, as opposed to partnerships which allocate income even if they do not need to allocate cash to cover that income. The third advantage of a REIT is that it's a pass-through, it can pass through capital gains income, unlike a C corporation. The fourth benefit is Section 199A deduction is available for REIT dividends, but not necessarily for owners of LLCs and partnerships. And fifth is it protects, by acting as a blocker, specialized investors, such as tax-exempt investors and foreign shareholders. With respect to tax-exempt shareholders, it protects them from recognizing unincorporated business taxable income from leveraged real estate and avoiding the dreaded complex fractions rules. For foreign shareholders, there are quite a few advantages. Foreign shareholders are protected from tax on effectively connected income, which includes real estate income, rental income, and gains from the sale of real estate or interests in LLCs or partnerships holding real estate. Instead, the shareholder is taxed on dividends, frequently at a lower treaty rate. It also protects the foreign shareholder from FOTA tax on the sale of REIT shares if the REIT is domestically controlled, meaning that the REIT has more than 50% of its values owned by U.S. shareholders. It also protects the foreign shareholder from the sale of stock of the REIT, even if it is not domestically controlled, if that shareholder owns no more than 10% of a class of REIT stock that regularly trades on an established U.S. market, meaning a publicly traded REIT. The third advantage for a foreigner is that they are exempt from FERPTA tax on REIT distributions derived from the sale of real estate if they own not more than 10% of a publicly traded REIT or not more than 5% of a non-publicly traded REIT. And lastly, if the foreign shareholder qualifies as a qualified foreign pension fund under the PATH Act, it is exempt from FERPTA tax on the sale of property, distributions, or sale of stock. So lots of advantages for tax exempts and foreigners as well as for domestic shareholders. What are the disadvantages? The disadvantages are few, but they do exist. One is that there is no pass-through of tax credits or losses, but you can pass through capital gains if the REIT so elects. It has strict ownership requirements and strict operational requirements / limitations as far as organization, assets, income, and distributions, as Bonnie will discuss in greater detail. And those limitations are designed to ensure that REITs follow their mandate, which was to be passive investment vehicles, and therefore its structure is designed to achieve those purposes. The last disadvantage is, unlike a partnership, but similar to a C corporation, there is no increase in stock basis for REIT-level dividends. Thus, distributions of refinancing proceeds, which we receive tax-free often in a partnership, may create capital gain to shareholders. So let's talk about the types of REITs. There are three different basic types of REITs. One is an equity REIT, which mostly owns real estate. There are mortgage REITs, which mostly own, as the name implies, mortgages. And the third type is a hybrid, which is sort of a combination of real estate and mortgages. There are two types of ownership structures. There are public REITs and there are private REITs. Private REITs are often used as blockers for tax exempts and foreigners. The chart above shows just a simplified comparison of REITs and LLCs. You know, a REIT basically pays out a dividend. An LLC passes through whatever the character of the income is, which in the case of a real estate LLC or real estate partnership is passive income. A REIT's dividend is eligible for the Section 199A deduction, and therefore it's taxed at an effective rate of 3.4%, while passive income is taxed at 40.3% if Section 199A does not apply. As we said before, REITs do not receive basis for entity-level debt. Partnerships do. REITs, as we said before, are taxable only in their state of residence, while real estate income from an LLC or partnership is taxed in the state where the real estate is located, and in both cases, generally, there is no entity-level tax. So let's compare current law, C corporation, LLC, and REIT. In other words, when you have a choice of entity to own real estate, what are some of the tax limitations or benefits of a C corp versus a LLC taxable partnership versus a REIT? So in this simple example, there's a real estate income of $1 million gross, $600,000 expenses, so net income of $400,000. For the C corporation, it currently pays entity-level tax at 21%, while LLCs and REITs generally pay no entity-level tax. Therefore, the net after-tax income is $316,000 for the C corp and $400,000 for the REIT and the LLC owner. Assuming that the taxable income equals cash flow, and assuming that all that is distributed out to the shareholders and the owners, for purposes of the C corporation shareholder, they pay an additional 23.8% on their income while the owners of the LLC and the REIT shareholders pay tax at 40.8%, assuming that there's no Section 199A available for the LLC owner, but 33.4% for the REIT shareholder. So the net result is that the C Corporation shareholder receives $240,000, the LLC owner receives slightly less, $236,000 and change, but the REIT shareholder receives more than both of them. It receives $266,000 and change, which shows an effective 60% after-tax income and cash for the owners of the C Corp and the LLC, but a 66.6% benefit for the REIT shareholder. So once again, shows the benefit of being a REIT over being a C Corporation or an LLC owner. Under the Biden's proposal, those numbers change somewhat, as we know. The entity level tax goes to 28%. The tax on ordinary income goes to 43.4% for the LLC owner and for the C Corp shareholder, but as of now, Section 199A still applies to the REIT shareholder. The net result is that the C Corp shareholder only comes away with approximately 41% of the income, while the LLC shareholder has 56% of the income, but the REIT shareholder, it has 64.52%. So there again, the advantage to the REIT over the LLC and the C Corporation actually increases. So just to summarize some of the Green Book proposals, as we said, corporate tax goes from 21 to 28%, but REITs generally do not pay entity level tax, so that would not affect the REIT. Capital gains are going to 39.6%, but REITs are still, at this point, eligible for the Section 199A deduction. There's a minimum tax on the book earnings of large corporations. It does not apply to REITs. And the limitation on capital gains, on like-kind exchanges, which would affect real estate for a REIT, especially an UPREIT. The exchange with an UPREIT can offer a viable alternative to this by allowing the contributor to contribute it to the UPREIT and then to get tax deferral that way. So in effect, it's a synthetic like-kind exchange. Next, Bonnie will cover the basic rules.
And we actually have a polling question first. So the first polling question of the webinar is up on your screen, and it reads, what type of company do you work for? Accounting, law firm, REIT, real estate owner, or other? Please make your selection now and be sure to click the submit button to get credit for your answer. We're going to give it just a couple more seconds. Please make your selection and make sure you click that submit button. Okay. Last call. Okay, let's just take a quick look at the results. All right, so it looks like the majority of the folks are from accounting firms. Now we'll pass it over to Bonnie.
Thanks, Sean. So now we're going to briefly go over REIT formation.
So just as Craig said, REITs are entitled to a dividends paid deduction, which you'll hear us refer to as DPD throughout the day, throughout the presentation. And we've included an example here where a REIT has $100,000 of taxable income. So the requirement of a REIT is that they must distribute 90% of taxable income, which here would be $90,000. But if the REIT only did this, it would need to pay tax on the remaining $10,000 of taxable income. So what we see in practice is the REIT will try to distribute 100% of its taxable income rather than just the 90%, and they don't have to pay any income tax. So in order to get this great tax benefit of the DPD that completely wipes out taxable income at the corporate level, a REIT needs to adhere to numerous requirements, and you see them listed here, and we're going to briefly go over the different tests. So first, we'll look at the organizational requirements that a REIT has to follow, and they're all listed out here for you to look at. There are two I want to highlight. About the fifth bullet point down, it says a REIT has to be owned by 100 or more people for 335 days. So for this test, the look-through rule doesn't apply, meaning say you have a partnership that owns REIT shares, that partnership is counted as one owner of the REIT. We wouldn't look through that partnership and say that partnership has 100 partners, say that the REIT meets that requirement, right? One entity equals one shareholder. And the purpose of the REIT needing 100 shareholders goes back to the intent of why a REIT was created in the first place, like Craig went over, where they're modeled after mutual funds, and you want to provide this opportunity to the masses to be able to own valuable real estate. So we see a lot of our clients use third-party service providers whose business is to find preferred shareholders, and the REIT gives a tiny percentage, maybe 0.1% to 125 preferred shareholders, and there you go, you meet this requirement. The other organizational requirement I want to highlight is the next bullet point down, that REITs can't be closely held. And this test is often referred to as the 5 or fewer. So for this test, not more than 5 individuals can own more than 50% of the REIT during the last 6 months of the year. So for the 100 shareholder requirement, one entity is considered one person to get to your 100 shareholders. But with the 5 or fewer test, you're required to look through until an individual is reached. Also, attribution rules apply here, meaning if you have a spouse or a sibling that's invested in the same REIT as you, you're deemed to own those shares too. So you just have to be careful here. The 5 or fewer test is much harder to pass than getting the 100 shareholders. A lot more of our clients would be REITs if it weren't for this test. We just see ownership is much more concentrated, that they can't overcome this particular hurdle. And again, the purpose of the 5 or fewer test is to provide this opportunity for the public to be able to invest and own real estate. The other thing I want to mention here is the last bullet. If you have an existing C Corp that's converting to a REIT, you have until the end of the first tax year of the REIT to distribute all of the C Corp's E&P. And so the rationale there is the E&P sitting in the C Corp should have to face double taxation. And if the earnings hadn't been distributed out yet, they haven't been hit that second time at the shareholder level with tax. So the IRS gives you this grace period of 1 year to clean house, and then going forward, the REIT starts fresh with this one layer of taxation. Okay, we're going to skip over these next 2 slides, but we'll be circulating a copy of the presentation, so feel free to go back and look at it. And we're going to move on to some more of these tests. Okay, so here we have listed out all of the asset tests that a REIT needs to abide by on a quarterly basis. At the close of each quarter, 75% or more of the REIT's assets need to be real estate assets or cash items. That means the remaining 25% of a REIT's assets can be anything other than real estate assets. There's also a 5% inbound test and a 10% outbound test. The 5% inbound test checks to see Not more than 5% of the REIT's assets are securities of any single issuer. And the 10% test looks to see that the REIT doesn't own more than 10% of the outstanding voter value of any single issuer. Of course, there are exceptions. The exception to the 10% rule is a QRS, qualified REIT subsidiary, and a TRS, taxable REIT subsidiary, which by definition a REIT owns 100% of. And we're going to cover those concepts a little bit later on. Lastly, there's a 20% TRS test. This test looks to see the TRS doesn't make up more than 20% of the value of the REIT's assets. So say a REIT during a particular quarter fails one of these tests. Do they lose their REIT status? Luckily, a REIT is given 30 days after each quarter to correct any failures. If it's past the 30-day window, so for whatever reason you didn't find the problem, maybe you realize that during the next quarterly retesting, there are mitigation provisions that are available, which we'll cover shortly. Okay, so here, these next few slides are an example, so you could see how the asset tests work. We're going to skip over it, but feel free to go back and revisit it. So I want to point out the percentage that a REIT is passing each of these asset tests is going to fluctuate throughout the year. What's important is that the test is passed on 4 days out of the year. So you're looking at March 31st, June 30th, September 30th, December 31st. As long as the tests are passed on those 4 individual days, you're good. If the REIT fails an asset test, it's past the 30 days after the quarter, there are provisions in place for de minimis and non-de minimis violations. So you'll see we split out what's deemed de minimis versus non-de minimis. For either violation, once the failure is identified, the REIT can either dispose of the bad asset completely, or the test becomes met within 6 months after the last day of the quarter it was identified. If you fall under one of the non-de minimis violations, unfortunately, you have to take it a few steps further, where 1, the failure needs to be due to reasonable cause, not willful neglect. 2, a description of the asset that caused the violation has to be attached to the REIT return. And 3, a payment that's the greater of either $50,000 or tax on the income that's generated by the non-qualifying asset needs to be paid. So usually the $50,000 penalty ends up being the higher one, and we've had clients had to do that. One would much rather pay that $50,000 penalty than the alternative of getting de-REITed. Okay, next we're going to briefly discuss the annual gross income test. There's a 75% income test that REITs must abide by, and you can see from the line items listed out here that they all relate to real estate in some way. The 2 most important are the first 2 that we have listed here, rents from real property and qualified interest on mortgage debt. These 2 items are going to be the bulk of any REIT's income. In addition to the 75% income test, there's also a 95% income test, which is everything included in the 75% test, plus interest, dividends, and gains from the sale of securities. So this leaves us with a 5% bucket. We call it the bad income bucket. So you're only allowed to have, quote unquote, bad income for 5%. Similar to the quarterly asset test, if a REIT fails one of these income tests and it's due to reasonable cause, not willful neglect, the REIT won't automatically lose their status as a REIT. So on page 2 of the 1120 REIT return, the 75% and 95% tests are reported. So you'll see it on the return, and if you happen to not meet any of these tests, the tax return is going to show a tax due. So the tax is 100% of the amount that the REIT is failing the test by. So if you're failing the 95% test by $50,000, the REIT would need to pay 100% tax on that, which would equal $50,000. This is very rare in practice, but just something you should be aware of. As mentioned earlier, rents from real property will make up a majority of any REIT's income. And so we wanted to point out here, related party rents don't qualify as rents from real property. And that's when a REIT owns 10% or more of a tenant. Also, rents from personal property don't qualify as rent from real property. So we've seen confusion here, and we just wanted to point out all rents from personal property don't qualify as good income. And so in practice, we don't normally see a separate lease just for personal property, and that's why we default to this 15% test. So for the 15% test, we look to see if personal property exceeds 15% of the fair market value of real and personal property on any particular lease. If not, then all the income generated from that lease is considered good. But if it exceeds 15%, whatever percent that is, we reclassify as bad income. So for example, if you have a separate lease just for a computer, that's personal property, and all of the rent relating to that computer is deemed bad income. It goes into your 5% bucket. But say you have one lease and it includes rental of the property, plus the chairs and the tables and all the furniture. You have a mixture of real and personal property there. So we would need to apply this 15% test. Say the personal property comes out to be 18%, then 18% would then have to be reclassified as bad income. Impermissible tenant service income. So this is income from services provided to tenants, and these qualify as rents from real property only if it's customary to provide that type of service in the area, and it's provided for the convenience of the occupant. And it's not provided for the convenience of the occupant. So if either of these requirements aren't met, this type of income is put into that 5% bad income bucket. Impermissible tenant service income is calculated as either the actual income received for that service or 150% of the cost, whichever is greater. So here we have an example. Assume an office building is owned by a REIT, and one of the tenants wants a painting hung in their office. The REIT doesn't charge the tenant for that janitor's time to hang this painting, but it is a service that's not customary for the area, and it's not provided to all tenants. So this should be calculated. And how we would calculate it is take the janitor's hourly rate times 150%. Now, if impermissible tenant service income exceeds 1% of total gross income generated from that one property, all income generated from that property is reclassified as bad income. And this is referred to as the 1% de minimis rule. So say a REIT owns several luxury apartment buildings, and the only way for that REIT to stay competitive in the marketplace is to provide these kinds of services that aren't customary for the area and are for the convenience of the tenants. So in order for a REIT to maintain that competitive edge, it can either have an independent contractor or form a taxable REIT subsidiary that can provide that service. Like, that's the workaround here. And the reasoning behind this is the majority of the income earned by a REIT should be passive, and a REIT shouldn't be engaged in a trade or business. So, and if they are, they should be paying that corporate level tax. They should have to face double taxation like any other C Corp. A TRS is a C Corp. So by having these types of services performed by the TRS on the REIT's behalf, the TRS will pay that double taxation and allow the REIT to maintain its competitive edge. Okay, we're going to skip over these next slides. This walks through the income test, so feel free to go back. And with that, I'm going to pass it off to Sean for your second polling question.
Thank you, Bonnie. So the second polling question of the webinar is up on your screen, and it reads, approximately what size is your company? Over 50 million gross revenue, 26 million to 50 million, 11 million to 25 million, 1 million to 10 million, less than 1 million, or I don't know. Please make your selection now and be sure to click the submit button to get credit for your answer. Okay, we're going to give it a few more seconds. Please make your selection. Make sure you click the submit button. Just as a reminder, you have to answer 3 out of the 4 polling questions to earn the CPE credit today. Okay, let's take a look at the results. Okay, so 53.3% of the audience at over 50 million gross revenue. Passing it back to you, Bonnie.
Actually, I think Don is going to pick up now.
Yes, thank you. Thanks, Bonnie, and thanks, Sean. So Bonnie's going over the organization, income, and asset tests that you need to qualify as a REIT. But now the REIT has to disgorge its profits. There's a distribution test it has to qualify for. And the basic rule, which is actually a fairly simple multiplication rule, is that it must distribute at least 90% of its taxable income as a dividend. And the catchword here is as a dividend. In other words, a distribution of return of capital doesn't qualify. Dividends are measured by an organization's earnings and profits. However, there's a special rule that REITs can take advantage of. The classic example is capital losses. So if a C Corp has a capital gain of $100,000 and a capital loss of $150,000, it can deduct the capital losses up to $100,000, and that $50,000 has to be carried over to the next year. Nevertheless, earnings and profits are reduced by that $50,000, even though it's not deductible in this year. REITs, however, have a relaxation of that rule. That $50,000 does not reduce taxable income. It's carried over, and it's only deducted when it's available. So this rule for REITs has the advantage of keeping earnings and profits high, so that an additional amount or amount that you need to qualify as a dividend for the dividends paid deduction qualifies. Now, there's 2 special distribution timing tests that I want to go over. I'm going to take the last item on the slide first. The throwback rule is a very beneficial rule, and it allows a REIT to elect to treat a distribution all the way up to the time it files its tax return, plus extensions. In other words, up to October 15th of the following year. The designated distribution during that time period and treat it as if it was distributed on the previous December 31st. In that case, the REIT gets a dividends paid deduction. The shareholders, however, include it as income in the year they get it. So there's a 1-year deferral for the IRS to collect its tax, whereas the deduction is in 1 year, the income recognized by the shareholders is in the next year. This is a qualification issue. In other words, this helps a REIT qualify as a REIT if you need to do it. The other rule, the January dividend, is not a REIT qualification issue. This is a special tax of 4% on the REIT, and we're going to go into that in the next slide. The January dividend is any distribution made during October, November, or December to shareholders of record in those months and paid by the following January 31st. In other words, there's a 1-month grace period. Again, this is to avoid a tax, and it's not a REIT qualification issue. Now, there are 2 solutions to help the REIT distribute money that it may not have. In other words, what if the earnings are used to pay back debt, they're used for CapEx, etc. So a REIT can declare what's called a consent dividend. That's an amount that's treated as distributed to shareholders, even though it's not. And it qualifies for the dividends paid deduction, and shareholders include it as income, frankly, as phantom dividend income. The shareholders get a slight benefit of getting additional basis in their shares, as if they contributed the amount they received back to the REIT. So whereas tax-exempt investors probably don't mind this much, taxable investors do. Yet, nevertheless, if this is what a REIT needs to keep its requalification, it'll engage in this. One thing to keep in mind is to check state law. California, for example, while allowing a dividends paid deduction, does not allow a consent dividends paid deduction. So something to keep in mind if you're operating in California. Another way is for REIT to declare a taxable stock dividend. This is a dividend payable in stock that doesn't qualify for tax-free treatment. Generally, because some shareholders get stock and increase their equity percentage in the REIT, while others get cash and do not. So there are several revenue rulings that have varied the percentage that you need to have in stock, but generally, a distribution can consist of up to 80% stock. The rest has to be cash, and it'll qualify as a taxable stock distribution, deductible by the REIT as a dividends paid deduction, includable in income by the shareholders at the fair market value. Now, once again, we're going to discuss the January dividend. This is to modify the results of a 4% excise tax that's imposed on the REIT if it doesn't distribute at least 85% of its ordinary income and 95% of its capital gains by December 31st. Once again, that 1 month grace period of January 31st helps this. And again, it's a tax on the REIT, not a qualification requirement. It allows the REIT to get an incentive to not give the IRS a deferral of that 1 year in taxing collection by the shareholders in 1 year and deduction by the REIT in the previous year. So one thing just to keep in mind, no matter how the REIT gets its dividend paid deduction, whether it distributes money under the January dividend throwback, uses consent dividend, taxable REIT dividend, it all qualifies for the dividends paid deduction. So let's talk about the mechanics. How does a REIT get or notify or tell its shareholders what kind of distribution it made? So if it's a capital gain distribution that the REIT elects to treat as such, the shareholders have to be told within 30 days after the year end or with its annual report. So on a 1099 div, the REIT designates whether something is an ordinary dividend, taxable at the shareholders' rate, now the maximum of 37%, a qualified dividend, taxable 20%, but very rare. This only applies if a REIT distributes money that's already been taxed, such as a dividend receives from Google, a dividend receives from TRS, which we'll go into a little bit later, or Section 199A distribution that Craig and Bonnie alluded to before, a capital gain distribution at 20% plus a 3.8% net income investment tax, or it could be unrecaptured Section 1250 gain, or a return of capital not taxable to shareholders unless it's in excess of basis, which is taxable at capital gains. One rule, however, that must be followed, although right now it only applies to private REITs and not publicly offered REITs, is that the distribution cannot be preferential. In other words, if A, B, and C each own 100 shares of a REIT and $1 per share is designated as dividend, A and B get their $100, but C only gets $75. The entire distribution of $275, not just $75, is disallowed as a dividends paid deduction. And that's something really to keep in mind because that can jeopardize the election to be a REIT. One way to solve it is to have two classes of stock. A and B can own Class A entitled to $1 per share. C owns Class B entitled to only 75% a share. Now, to review the operational test, we've gone over these. I just want to point out the last point. Whereas REITs normally operate through partnerships or LLCs, and the rule you have to follow is that a REIT owns its capital percentage, which is a constant amount of the assets and income of the partnership. For example, if a REIT owns 20% of a partnership, it owns viewed as owning 20% of the assets, no matter their character, and 20% of the income, whether it's ordinary income, capital gain. This does not have anything to do with special allocations under 704B. In other words, a special allocation appreciation is ignored, preferential distributions are ignored, different percentages of different items of income is ignored. This actually rule has come under some criticism in the past. The IRS has always thought to have taken it up and considered it. So far, nothing has changed. As far as REIT level taxation, we've gone over most of this. What happens is even though a REIT gets a dividends paid deduction and can wipe out income at the corporate level, nevertheless, if it engages in certain behavior, as Craig and Bonnie have already alluded to, it can be taxed at its level. Two things I just want to point out here. We never went over the income from foreclosure property. This occurs if, for example, the REIT made a loan secured by property, there's a default, the REIT takes back the property. If it's an apartment building, commercial property, whatever, there's no problem. The REIT could always collect that rental income anyway. If it's a hotel, that income doesn't qualify as good REIT income, and it's probably exceeds the 5% bucket. In that case, normally you'd lose your REIT status. In this foreclosure property, the REIT won't. However, it will be taxed at the highest corporate rate on that amount. There's a grace period of getting rid of this property within 3 years that can be extended to 6. Prohibited transaction tax 100%. Craig's going to go over this in about 30 seconds. Subsection 1374, built-in gains. If there's a conversion from a REIT from a C Corp to a REIT, which Bonnie alluded to, then the REIT cannot sell that property for 5 years. If it does, there's a tax at a corporate rate on that gain. And finally, there's 100% tax on non-arm's length transactions with a REITs TRS. I'm going to go over to that in a couple of slides. And now I see we have another polling question. Sean.
Thank you, Don. So the third polling question of the webinar is up on your screen, and it reads, have you had experience with public REITs, private REITs, prohibited transactions, taxable REIT subsidiaries, or none of the above? Please make your selection now and be sure to click the submit button to get credit for your answer. We're going to give it 5 more seconds. Again, remember to click the submit button to get credit for your answer. Please make your selection now. Okay, let's take a look at the results. Okay, so it looks like 46.3% has experience with private REITs, and then it's followed closely by taxable REIT subsidiaries at 37%. So now I'll pass it to Craig.
Thank you, Sean. The next topic is prohibited transactions. Prohibited transaction. So let's state the rule itself, and then we can talk about it in a little more detail. There's 100% tax on the gains from prohibited transactions. A prohibited transaction is a sale or other disposition of property that's been held primarily for the sale of customers in the ordinary course of business, known in the vernacular as dealer property. This rule applies to all REITs, both equity REITs as well as mortgage REITs. Gains on prohibited transactions, which are subject to the 100% tax, cannot be offset by losses from other related prohibited transactions or other losses, such as net operating losses. For example, the classic case is a purchase of a building with the intent to sell it. You develop the building as condos, and then you sell the units. A sale under the prohibited transaction rules also includes sale of property by a partnership in which the REIT holds a direct or indirect interest under Reg Section 1.856-3G. Okay, why does this rule exist? It's a pretty harsh rule. Why does it exist? Once again, a little history. The 1960 Act, which created REITs, envisioned the REIT as a passive owner of real estate, not a person who is in the active trade or business, not a person who is a seller of real estate, not somebody who was a developer. Thus, they created a flat prohibition against the REIT holding property primarily for the sale to customers in the ordinary course of business. If there was such a sale, even one, it would result in the disqualification of the REIT status. So a strict prohibition against dealer sales. Recognizing the harshness of this rule, in 1976, Congress changed the rules from a disqualification of the REIT to a 100% gain 100% tax on the gain, which is the rule today. However, recognizing the difficulty of determining whether a sale was a prohibited transaction, in 1978, Congress created a safe harbor, allowing for up to 5 sales per year if the property has been held for at least 4 years, among other requirements. This safe harbor rule in present form is the rule that still exists today. And lastly, Congress has liberalized the rules from in 1986, 2008, and the latest in 2015, increasing the number of sales allowed and shortening the holding period from 4 years to 2 years, among other modernizations. So, when faced with a potential sale, whether you or your client is thinking about, what do? Well, there's certain courses of action that are available to a REIT to escape this tax. One is that the REIT can comply with the statutory safe harbor, which we will discuss in the next slide. A second possibility is that they can transfer it to a TRS and let the TRS make the sale. The sale would be subject to a 21% corporate tax, but it would eliminate the risk of 100% tax. It also could be offset by losses within the TRS, subject to certain limitations. The only limitation that also applies is that we have to make sure the seller is actually the TRS under the court holdings doctrine, so that the negotiations for the sale are done by the TRS and not by the REIT. And lastly, the REIT can rely on case law, which talks about a number of facts and circumstances, which we'll discuss presently. Prohibited transaction. What are the safe harbor rules? So the existing safe harbor rules, which were last modernized in the PATH Act of 2015, so it requires a number of elements that will allow the taxpayer to avoid being subject to the 100% tax, but you must meet all of those elements. In the interest of time, everybody can read it, but basically it's a 2-year hold for the production of income. The capital expenditures have to be less than 30% of the selling price. The number of sales are limited to either 7 sales a year, or there is a 10% annual limitation based on either basis or fair market value, but with a 20% current year limitation as part of a rolling 3-year average. All the marketing needs to be done by either an independent contractor, or since 2015, it can be done by a TRS if there are more than 7 sales. So the bottom line here is that if a REIT is a partner in a partnership, it needs to take certain protection for itself, because, as we said under 856 3G, that it can be attributed, would be attributed the activities of that partnership. So the REIT has to aim for either control over the partnership, have consent rights with respect to a sale, or put into the partnership agreement that the sales would only be made if in the safe harbor. There are a number of facts and circumstances. You can read them there, but basically there is items that have been developed by the courts in the real estate area, not necessarily the REIT area, that talk about when somebody is a dealer and when somebody is holding it either as a trader or held for investment. Next, I will turn it over to Don to talk about TRSs.
Thank you, Craig. Not sure how much more time I have, so I'll be very brief. TRS is a corporation owned by the REIT, typically 100%, but it can be less. If it is 100%, you know from Bonnie's presentation, there would be a QRS and ignored. So a TRS must make an election with its parent REIT to be treated as such, and that's made on Form 8875. On this slide, I showed you the advantages of being a TRS and some of the disadvantages at the bottom. I'm not going to go over everything, but the saving grace is that in our very next REIT webinar on September 2nd, we go into all the details and all the operations of how a TRS operates. The next slide, I do want to spend a minute on how do we get income from the TRS up to the REIT. It can be a dividend, which does qualify under the 95% test for REITs. However, the TRS will be taxed on the income. It could be interest on a loan made by the REIT to the TRS, and therefore the TRS can wipe out a lot of its income, the income at the REIT levels, and distribute to shareholders, and there's no income at that level either. There are some limitations on the deductibility of interest that came in 2 years ago on 163J. However, there is a way for the TRS to get out of it if it declares itself to be a real estate property operating company. Finally, the last point I want to discuss just in 30 seconds, the concept of leakage, which is basically, can a TRS show losses every year and not be audited? Can it show flat income every year? A lot of practitioners adopt a rule of thumb that a TRS can show 3% quote leakage. In other words, a 3% profit margin, and it shouldn't be bothered by our IRS. The downside to this is business. And if the IRS sees an artificial 3% rate each year or something close to it, that may trigger an audit because there may be something going on at the TRS level that shouldn't be. Again, we're going to have our webinar on September 2nd on details of TRS operations. And I think our next slide is our last polling question. Sean.
It is. Thank you, Don. So the fourth polling question of the webinar is up on your screen, and it reads, what sectors do the REITs you have experience with operate in? Apartment, commercial building, retail, industrial, hotel, healthcare, or other? Please make your selections now and be sure to click the submit button to get credit for your answer. We'll give it a few more seconds. Make sure you click the submit button. Okay, let's take a look at the results. Okay, so 47.9% is a commercial building, followed by 40.6% of the audience saying retail.
All right. Thanks, Sean. So here we included a slide detailing common elections that are made within a REIT structure. Unfortunately, due to time constraints, we're going to skip over this, but feel free to go back and look at it on your own. And as Don mentioned, our next webinar, webinar 2 in our series, is going to discuss impermissible revenue and TRSs in great technical detail. Today was more of a general overview. So webinar 2 is scheduled for September 2nd, and you should see a button on the right-hand side of your screen that would allow you to register. So feel free to do that now, and I'm going to pass it back over to Craig.
Thank you, Bonnie. That concludes today's webinar. We hope that everybody enjoyed it, and we hope to have you participate in our future webinars. Our next webinar will be on impermissible tenant services and TRSs, and that'll be on September 2nd, 2021 at 12 o'clock. Thank you, everybody, for coming.
Thanks, Craig. We hope everyone enjoyed today's webinar. Thank you once again to all of our speakers. If you've completed the CPE requirements, your certificate is now available for download. You'll see the instructions on the screen now. If you're a Mazars employee, no need to download the certificate. We also encourage you to tell us what you thought about today's webinar by completing our feedback form, the link to which you will see on the screen shortly. Please take a minute and click that link once we conclude here. We hope you will join us on our next webinar in the series on September 2nd. Please click the button on the right-hand side of your screen to register now. Feel free to reach out to any of today's presenters or myself with any further questions. Thank you once again and enjoy the rest of your day. Stay well, everyone.